that time again. It's February the 17th. It's a Thursday. We're a day early because I have to go to New York tomorrow. Has it been an interesting week, Keith? What's been happening?
Very interesting week. Well, Manchester United won, which hasn't happened for quite a while. So that was good. What happened to Spurs?
We are not involved in your competitions. We declined. We were thrown out, actually.
Yeah, that's right, for not
which
traveling.
was a favor to us.
Yeah. So no, it's been a big week. The title of this week's newsletter is Uneasy Bedfellows.
Where'd you get that photo from? Where is that woman?
I don't know, but she's growth capital and he's seed investor in my designation.
Well, actually, the reverse is true, I think.
Well, could be. I want to hear a justification for that point of view.
Well, the growth guys are that's Paul Graham in drag, right?
That's Paul Graham, and the tall partner is Tiger Global.
Yeah. I mean, I get the point, but I don't really understand why they're bedfellows. They don't have anything to do with one another. Seed investors and late stage venture capital. I mean, one is involved at the beginning, one at the end. Their paths do not cross.
Yeah,
they're never on the beach together.
You would think that would be true. What am I trying to do here? There you go. That'll do. You would think that would be true, but actually their paths are crossing more and more because the growth investors are investing earlier and earlier, and the seed investors are trying to invest later and later. So they're kind of meeting in the middle, and they've got to figure out what their relationship is. That's the point of the editorial, and it's
why.
You'll see in a minute why, because if they don't, then I can tell you as an insider, lots of seed managers really don't like growth investors. Why? Because when they come into a company, they typically don't allow the seed investor to put more money in to maintain their shares. It's almost like they're competing for a small amount of equity in the deal, and they become enemies.
So they have entirely different worldviews, entirely different business models, entirely different types of people. I mean, you profile two in the newsletter this week. First, Coatue, which is very late stage, and then our old friend Paul Graham pops up, who's the ultimate early stage guy, and they have entirely different ways of doing business, attitudes to business, mentalities. I just don't really see why or how they would ever have anything to do with one another. How would Paul Graham ever bump into Coatue?
A lot of the time he would bump into them in the companies he already owns shares in later on. But,
he doesn't care, though. The point of Paul Graham is, as he says in your feature on him, he's in the business of making 200x or 1,000x. And once he bumps into these late stage people, he's already made his 200 or 300, so he doesn't care.
No, in fact, well, the truth is the late stage people make it possible for him to do his 1,000x because they come in at, let's say, the A or the B round and write big checks that are usually overpricing the company prematurely. And suddenly the Y Combinator investment, which was worth 10 million, is now worth 200 million. After a single round. So there's a symbiotic relationship between the two, you're quite right. But they live in different worlds, different planets. And look at what Paul says here. I've never read a business plan or a balance sheet.
Have you ever read one? Why would anyone? You've written them and they're always lies, Keith. Everyone I've ever seen of yours is made up. You're a novelist. Like all founders.
But compare that to...
I think Paul Graham should be commended for telling the truth. Why would anyone ever read a business plan?
Well, I'll answer that in a second. Look at the Coatue profile. It says data science offers them an edge. They began in 2014 investing in data science capabilities, and the years since it's built robust platform that surfaces credit card data, customer lists, and company comparisons. Though some question its utility, it is favorably received. So unlike Paul, not only do they read business plans, they apply artificial
Yeah,
intelligence.
but to be fair, by the time a company gets in front of Coatue, they need a business plan. So it makes complete sense. But there's a couple of guys
Well,
with an
now
idea. Why would they waste Paul Graham's time or their own time with a business plan?
because Paul Graham's biggest question, and if it isn't, it should be, is who will fund this company later? And the answer to that question is all in the business plan. That if you invest without knowing who will fund it later and how much they're likely to fund it, then you're blindly.
Yeah, the kids, I mean, the Google people didn't know that. The Facebook people, I mean, that's.
No, they actually Google had a very developed business plan right at the beginning, which was all to do with the number of clicks on searches.
Yeah, but their business, when they started, they didn't even have a business model, and they were the whole purpose of the company was to be against advertising, and then they turned into the biggest advertising company in the history of the world. So I'm very much in Paul Graham's camp here. I don't see any point in business plans.
Yeah, but that's why
That's why I don't have a startup.
I can tell you, I will not invest in a company where the founder can't explain to me what he's going to do.
But that's a different issue, Keith. You
Well, a
can
business plan
explain it without a business plan.
The business plan is another way of saying, what am I going to do?
Well, you could write a one-pager. If that's a business plan, that's fine.
It's
But what's the point? I mean, Paul Graham.
I'll tell you the best business plan ever written was the Netflix one before they raised money. And it was only a single page on a spreadsheet. So you're right, it was a one-pager. But it was an entire ability to understand what their future model is likely to be based on subscriptions to DVDs in those days. It didn't include streaming, of course, so it couldn't know everything.
Yeah.
But it showed a multi-billion-dollar opportunity even before they got going. So now you knew that if they executed, it was going to be big. Well, you kind of do want to know that, right?
Yeah, but you don't need a business plan. You can just go and sit in a room and explain it. I'm not saying they shouldn't have. I mean, anyone with a startup has an idea of what they're doing, or otherwise they wouldn't be doing it. But I think Paul Graham's point, I mean,
I know I get his point. I mean, I actually agree with you on the point you're making, which is he's really investing in people, and that's fair enough. I can tell you, I also do that, but it's really hard to figure out who's a good person. I've made money with some crazy people who are sometimes not even fully honest, and I've lost money with awesome executors who were scrupulously honest. It's pretty hard to judge people at that early stage, but you can judge markets and you can judge.
Okay, well, enough of Paul Graham because we talk about him every week. What about these Coatue people? What's interesting? What distinct? How and why are they different from Tiger?
They're different. They're different in the following way. Tiger is kind of building an index on top of the fastest growing companies. So it's almost like a very large check writing spray and pray model.
Yeah.
They do have criteria, but it's pretty broad. Whereas Coatue is a data driven, justify why we should write this check. They're also writing a lot of checks because there's a lot of companies that pass the test. But their approach is totally different. Now, the founder of Coatue is French and trained in Cartesian mathematics and logic. And the founder of Tiger Global is American with a focus on Asia, who is more of an empiricist. So
they're both very much Wall Street models of quantifying investment. They're not really very entrepreneurial, or certainly not early stage, right?
They're doing more and more early stage, but you're right. They're basically hedge funds from a private equity world that are not used to venture. So the difference between venture and private equity is private equity has a 3 to 5 year horizon and wants to turn the money into 3 or more times the money in that time period. Venture wants to get 1,000x return in a much longer period. So these are not venture funds at all. They're much more short term.
Do you think they think of themselves as gamblers, the Coatue people? They're trying to eliminate any kind of gambling. They're trying to establish certainty as much as they possibly can.
Right.
Whereas the early stage people are just, I mean, they are gambling, but they're good at it. They're smart.
I think it's a little. I think the early stage people are like artists. Some artists are awesome, others are really bad, and the artists that are good over and over again, and they kind of capture the genre of an era. So if you think about the really good seed managers, they, they, I can name them. The viewers probably don't know these people, but like Christoph Jans is a god when it comes to SaaS. So is Thomas Tungers. There are others that are gods when it comes to consumer. There are others that,
Right. But
some.
I bring up gambling because that's another of your themes in the newsletter this week. Gambling is big. Well, we knew it was big, but it's even bigger now, right?
Yeah, gambling has really taken off here in the States, which as Brits, I don't know about you, I grew up with my mum and dad going to the bookies on a Saturday and putting bets on horses.
Yeah.
And later the bookies evolved and you could bet on everything and even have spread bets now. So gambling in the UK is like wall to wall. And when you can't turn on the TV and watch a game without getting the odds given to you by the gambling company owned by the TV channel. So the States has been much more Puritan about gambling until very recently. And at the state level, there are now lots and lots of states, 33 it says here, that have deregulated and legalized sports gambling. And as a result of which, something like $140 billion is about to pour into sports gambling over the next few years, which dwarfs many markets. And it's going to be big. Who knew?
Yeah, it's. I have to admit, I agree with you. I'm surprised. I didn't realize that that it wasn't already big in America.
Yeah. I mean, it's big in Vegas. If you go to Vegas, you can see it.
This is bad news for Vegas, isn't it?
It is. Well, we'll see. Hard to tell, but
so what is it? All online stuff? I mean, basically, you can bet on anything. You can bet during games, before games.
Correct.
And will there be a Web3 version of gambling, or is it all Web 1 and 2?
There will almost be a Web3, but none of this stuff is Web3. It's all Web 2.
And then Facebook in decline. That surprise, surprise. We've been covering this for a while, Keith. But it seems as if things are really sliding now at Facebook.
Yeah, well, the narrative has shifted strongly against Facebook, and their stock price is displaying that. This is a really good article from Vox about whether the advertising hit that Apple has inflicted can be fixed. And there are all kinds of people who think it can be somewhat fixed, and that article is a good read for that reason. This one is different and really important, and it echoes something we talked about a few weeks ago, which is that the metaverse, as understood by Zuckerberg, requires computing tech that no one knows how to build. So it really is a dream with no end game. And here it's saying it's decades until some of the things he describes could actually work.
Well, does it require quantum computing or some major leap in computing power?
It requires a major leaps in optics because you've got to interact with eyeballs.
Yeah.
Without encasing people in a suit around their head. So that's the main thing. It's optics, and optics are about rendering space.
Yeah.
So if you think about the room you're sitting in or I'm sitting in, if we were wearing glasses and we wanted to project something, we'd have to map the room from every angle as we moved our heads and be able. So that kind of math is really, and with depth is pretty impossible.
Why has Zuckerberg taken a gamble? He's a smart guy. He understands tech as well as anyone. Why would he gamble on something that he can't realize because the technology isn't there?
It reminds me of a lot of entrepreneurs, which is when the world doesn't go their way, they invent a new world in their head and say that's their world, because now they can escape all the constraints of the actual world that they're having to play in. And so he's shifting the narrative to a place that he feels comfortable no one else is playing in.
Yeah.
He doesn't really yet understand that you have to follow through on that if you're going to say that. And in their day-to-day decisions, he's actually deviated from it already. They've made it an internal priority to compete with TikTok, which had nothing to do with the metaverse. So you can see it's probably well understood that this is a long roadmap with no end game and no sure way of getting there.
And you said there were 3 things. What was the third?
The third is that Nick Clegg, who is known to you and me from the UK, has been promoted to be, his exact title is Head of Global Policy, I believe. Let's just click on it.
So he's the government guy. Yeah. So what's the big deal about that? I thought he always was. Who was the top policy person?
President of Global Affairs.
So it just means he deals with government.
Well, it means he reports directly to Zuckerberg, not to Sheryl Sandberg. That's the main change.
Well, that big deal. Who cares?
He probably cares.
Who, Clegg or Zuckerberg?
Clegg. I mean, remember what he did with David Cameron. He likes to be in the big room with the boss.
Yeah, I mean, it's a mystery why they have him. And it's a mystery why Sheryl Sandberg is still there. And it's actually a mystery why we're even talking about them, because they're increasingly irrelevant.
I think we agree on that. This is probably the first time we've had a Facebook agreement for quite a while, Andrew.
So we can move on. Maybe next week, Keith, we won't have Facebook. And then what about Essay of the Week, new feature?
Yeah, Essay of the Week is a bit of an experiment. Let's hope there's enough essays in subsequent weeks to justify keeping it.
Don't do a Zuckerberg. Don't invent something where we don't have the technology or the content for it.
So there's two this week, and they're both worth spending a Sunday morning, really thinking about. The first is from a really well-known guy in the IT space called Phil Windley, who's he runs the Internet Identity Workshop for many years now.
Right.
And he's written a piece called Framing and Self-Sovereignty in Web3.
And that's a classic Web3 kind of title, which sounds really interesting, but you have no idea really what does self-sovereignty mean?
Self-sovereignty means you can prove who you are without any third party needing to help.
Oh, okay. And that's interesting. And what's framing?
And framing is the context within. So framing is the means by which objects are delimited, qualities unleashed, and art is made possible. So
I used to get in trouble from everybody when I used to say the biggest problem with the internet is you need to get rid of anonymity. But if you describe it as self-sovereignty and you put it in Web3 language, all the Phil Windleys of the world have an orgasm. So this is all we're doing is getting rid of anonymity, which is one of the great curses of the internet, right?
Right. So he makes the point that sovereignty is how we create a home in the digital world. So it's not just who we are, but where we are and what we own.
So all this means is that the high-tech community is coming around to the idea that anonymity is a disaster and that they have to embrace the kind of transparency which requires us to reveal who we are. Yeah, you call it self-sovereignty, but...
Yeah. Actually, anonymity is not really a goal of Web3. It's a feature of some implementations. But if you look at those people who got busted for stealing Bitcoin last week,
yeah,
they were caught because they used blockchain. It wasn't possible to know. The story is kind of interesting. They stole passwords, which is how they got in. So it wasn't a tech success. It was just a regular stealing passwords. Then they put the money into all these different wallets. And it was obvious on the blockchain that everything came from this one wallet and went to all these other wallets. So now you could track all these wallets. And as soon as they moved money from one of those wallets to somewhere in the real world, you knew who it was.
Yeah, I mean, I think anyone who steals Bitcoin anyone who steals from the blockchain, it's asking for trouble, because the whole point of the blockchain is there's that element of transparency, right?
Exactly. You can wipe your fingerprints off the door of a bank, but you can't wipe a ledger entry on blockchain.
So actually, so this essay is really interesting. I mean, I'm not sure I like the phrase self-sovereignty, but what it means. So what does it mean, Keith, that we can maintain our privacy, but also we can't hide behind anonymity?
It's both. Yeah, it has both. This is Phil's diagram of everything, and it's very geeky. So, and we haven't got time to explain it all, but there's lots and lots of one-to-one relationships, and it's possible to do business with someone you're not directly related to through an intermediary, where trust carries on the network in a way, without either side knowing who the other is. But
Now that's promising, and it shows that Web3 can be important. And then what was the second essay again?
And the second essay, which is equally interesting, is Thomas Tungers, who we've mentioned on the show before, is from Redpoint. Let's put it up. Thomas is writing about lessons of mergers and acquisitions after he's done $5 billion worth. And he has these 10 lessons, and they are, as someone who's been doing mergers and acquisitions for the last 12 months with 2 or 3 different companies, I can tell you these are so correct. It's uncanny how good they are.
Yeah.
It's things like you must build a relationship to the acquirer, because no one buys you unless they really know you very, very well. Another good one is be wary of first-time acquirers. They may want to buy you, but they don't know how to, and it's going to drag out. They're going to make all kinds of mistakes. Obvious one: the deal isn't done until the money's in the bank. Deals collapse even on the last day. There are 3 types of acquisitions: acquisitions of teams, acquisitions of teams plus technology, and acquisitions of teams plus technology plus traction. Each one is more valuable than the one before it. So you really want to be selling team, technology, and traction, not...
What happens if you have traction and no team or tech?
Yeah. Regulatory delays have become more common as cross-border approval has to be gotten. I'm involved in one now that involves CFIUS, which is the US rules governing selling a company to a foreign buyer. And the reason this one has to go to the CFIUS committee is because the buyer CEO is a Russian national, even though the company is a Delaware corporation. So regulatory.
But the 11th
these are
from
great.
Congress should be don't do any deals with Russians ever, right?
Exactly.
And then startup of the week is a curious one.
Startup of the week is BlockFi, and the reason it's a startup is it's having to go back to square one. We've talked about BlockFi before. They're a DeFi company providing interest rates if you agree to store your cryptocurrencies on their servers. And depending on the currency in question, it's anywhere from 3 or 4% all the way through to 17, 18% interest. And this week, the SEC made an agreement with them not to send them to jail if they'll do 2 things. One is pay $100 million to the SEC, which is a lot of money.
What have they done wrong?
Basically, it was deemed by the SEC that they were essentially selling securities to people, not tokens, and that the interest rate was all about security. And you're not allowed to sell securities to non-accredited investors. So the deal they've done is, going forward, they'll only offer these interest rates to people who have $3 million of liquid net worth or more. So it's like a super accredited investor, similar to the people allowed to invest in venture funds.
So that's not a bad policy, is it?
There's 2 ways of looking at it. One is it's good because it protects poor people from losing all their money. And the bad way is it's bad because it means only rich people can benefit from high interest rates. So it depends which way you look at it. It is what it is. Good article on TechCrunch describing it. And BlockFi, I'm a subscriber. When I went to the website the day after this, everything's changed. Stuff I could do before.
Why can't 1,000 kids get together and pool their worth and do it?
It wouldn't be
A
allowed.
1,000 kids, each worth $3,000.
It wouldn't be allowed because there wouldn't be an accredited investor is by definition an individual or a company. And so if they formed a company and the bar's much higher for a company, I can't remember the number, but I think it's closer to 20 million or 10 million of.
Yeah.
Anyway, the SEC doesn't, as we saw with the Jobs Act thing earlier, the SEC does not like normal people being able to play in.
So,
these
what grade do you give the SEC on this? A B, a C, or an A?
I personally think that this is overregulation in the extreme, and they should just they should make disclosures required, but then they should let people take risk.
Well, I mean, if you really want to take a risk, you use one of these new gambling sites, right?
Yeah. Well, yeah, I mean that is a real risk. That is gambling.
I mean, in all seriousness,
well, isn't it?
I mean, why let kids gamble and not do this BlockFi thing? It seems just as big a scam as gambling, but
yeah,
right. I mean, why let them bet on football games at half time when they can't do this complicated thing on BlockFi?
Yeah, exactly. Gambling is a way worse thing than investment. Way worse.
And way more corrosive in a cultural cycle.
But I think, the conspiracy theorists will say the SEC is looking after people who make markets and preventing volatility by preventing large numbers of ordinary people playing in those markets. I don't really buy that. I think the SEC is probably genuine in wanting to protect people.
Well, who's that woman you don't like? She's not in the SEC. She's in the FCC.
Yeah, she is, yeah.
What? Remember her name?
I do, Lena Khan.
And what is it about her you don't like, Keith?
She's totally unqualified to be a regulator.
She wrote a student paper, didn't she?
She did.
Should Lena Khan be allowed to be in the FCC?
Oh, she should be allowed. We don't want to ban her. We just don't.
Can't we do the same as the SEC and ban women from all senior appointments?
Oh, I wouldn't say that. You could say that if you want, but I favor women in senior appointments.
So do I.
Funny enough.
And finally, tweet of the week.
Yeah, this is Lee Edwards weighing in on the.
Who is Lee Edwards?
Lee Edwards is, I have no idea. Let's take a look. Lee Edwards is a partner at Root VC, investing in developer tools, data and software infrastructure, and AI. He formerly was the CTO and vice president of engineering at T-Shirt Model, whatever that is.
I think, Keith, there should also be laws that you're only allowed to call yourself a VC if you have, over 50 million invested?
Yeah, I'm not in favor of regulation generally, so I wouldn't go there, but I understand why you say that. But anyway, for what it's worth, Lee...
So he's not a VC.
Here's my guess.
He's some guy who made money and now probably invests a little bit of money here and there.
Yeah, so this is my wild guess. I think Lee and his partners had a debate internally this week about whether they should improve their website. And I think they disagreed, and Lee tweeted, "A lot of people misunderstand what a VC website is even for. Nobody Googles looking for a VC website, and any VC firm that wants SEO deal flow isn't worth finding. 90% of VC firm website traffic is direct, 3 primary audiences, limited partners, founders, and other VCs." So this smells of a bitter partner in a VC fund arguing with his colleagues.
Well, if it's bitter, I think he's telling the truth, isn't he?
I agree with him.
What's bitter about it?
I think there's someone on the other side of this argument that hasn't appeared in print yet.
Do you think he's related to Duncan Edwards?
Duncan Edwards, viewers, was the famous teenager who died in the Munich air crash. He was a 19-year-old Manchester United player who died along with many others in 1958 and was already playing for England and probably would have been the best player in the world, everyone reckons.
He would have been the best player in English history. He was Gascoigne without the attitude, basically.
Yeah. But no, I don't think he's related to him.
Well, I think that the tweet is quite interesting in the sense I just redid my website, and websites are completely pointless now. I did my website because the only reason I have a website is for publishers and people I sell speeches to. So I had 2 links, and that's it. I mean, I guess the website was supposed to have died 15 or 20 years ago. Does it even exist? What are you doing with your startup and your website?
It's a huge debate internally.
Now we're getting the truth, Keith. Now, I bet Lee Edwards is you. You were doing that anonymously.
Let me show you. This is the Single Rank website. That's it.
That's exactly right. And are you the one saying it needs to be completely minimalist?
Yeah.
And what are some of your people saying? Oh, we need more links.
How will people find out about us?
What?
They say, how will people find out about what we do? And my answer is, we don't want them to know what we do.
I agree. I did. You can show my website. Put me in. ajkeen.com.
ajkeen.com. Here we go.
Probably
that's much prettier than mine.
See, look at that.
I do believe that was in Amsterdam when I was with you.
No, it's actually in Copenhagen, but it could have been Amsterdam. So I've got 3 links: how to fix democracy, keen on, and about Andrew, and that's it.
Where is that was the week?
Oh, no. You see how important it is. Well, it's sort of keen on.
It is, sort of.
Yeah. Well, the website's dead. Facebook's dead. Gambling is big. Paul Graham is even bigger. It's been a bit of a week, Keith.
Bit of a week. Bye, everyone.
Edwards just reappeared as Lee Edwards. So it's been an interesting week. And no doubt next week we will talk about venture capital again. You know, in your brain, venture capital is everything. It's not as important, I think, as you think it is. Other stuff happens in tech rather than venture capital.
I know, but it's just where I work, so it's what I'm obsessed with, and hopefully some of my readers agree.
Good. Well, good show, and we will be back hopefully. And I think you're definitely a pervert because that is such a weird photo. I don't know. Did you make that photo or did you find it?
I Googled strange couples.
Did you show that to Janae?
I should tell you all, you should all Google strange couples and see what comes up. But that was the best picture as far as I'm concerned. I think it's a great picture.
Did you show Janae?
I did, actually.
Well, that's Duncan Edwards and Lee Edwards. Well, congratulations, Keith, on another successful week of tech. And we will see everyone next week on our regular Friday. It's almost the end of February. Time flies. February 25th. Our last, second to last Friday this week. It's our last Friday in February next week. So we'll see you all next week.
We definitely will. Bye, everyone.